Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. And we are back, episode 150 of Carson's Facts versus Feelings, Ryan and Sonu. Sonu, we thought about who do we want to have for episode 150. We wanted somebody special, and it's a third-time offender, I believe is what we're going to call it. I'll let you introduce the guest today. Obviously, we're super excited, though.
Yeah, legendary investor, maybe. I'll just say Cliff Asness. Cliff, so great to have you on. I mean, I don't think an intro is necessary, but our compliance likes titles around here. So maybe you can give you a title.
Co-founding partner, managing principal, chief investment officer, AQR Capital Management. Not sure I got that all right. We don't focus a lot on it, but somewhere in there sums up what I do.
Yeah, that captures the crux of it, I think.
It's actually a funny story. I don't think I was ever formally CIO. I think I was de facto CIO. And I think what happened is we needed to fill out a CIO on like RFPs and stuff. So I kind of got granted the title just because bureaucratically we needed somebody. And then I was de facto doing it. So I don't think that's actually an official title, except we have to use it on forms.
Okay. Well, we'll take this as official. So
yeah, it's official now. I believe this is, again, the third time you joined us. So every time you come on, it's always such an awesome discussion. We're obviously huge fans of you and AQR, and it's just it's gonna be fun. So we'll go about 40 minutes. We've got some stuff we wanted to ask you. I guess the first one that I had when I look, how much fart coin do you really own?
I
know Kevin's about to jump on already. That's a joke for us. For
the few out there who don't follow every single thing I write,
yes.
Ryan is referring to a blog I wrote, which has a central conceit to it that it's 10 years in the future, and I'm an institutional asset allocator looking back at the last 10 years, and it is a very thinly veiled structure designed for me to implicitly say I'm right about everything I'm saying today, because this person 10 years from now is telling you what happened, and it happens to be what I'm predicting is too strong of a word, but what I think will happen. And I did express that I'm not necessarily I wouldn't massively short crypto. Younger and smarter people than me know too much, and I'm not that confident. But I'm a crypto cynic. That's fair to say. So I did say that I think that doesn't work out as well for people as they think. But this was pure humor. I said the only thing that did work out was it turned out Fartcoin was the superior technology, and is the crypto that won. And the funny part is, some people who give this a cursory reading will still like tag me on Twitter when Fartcoin is down and be like you're wrong. And I'm like I can't be either right or wrong. I was totally kidding. But you get that. But I think the Fartcoin people have succeeded because they have serious people like you guys, like me, saying Fartcoin over and over again.
True.
So
yes,
they
that's
win.
One measure of success.
They've won.
Yes. Mm-hmm. So I guess, Cliff, you're not doing any drinking games and screaming fiat.
No.
And buying Bitcoin.
I have one more name of meme coin story for you.
Yeah.
Total joke. AQR will never be doing a meme coin. But I joked that I'd love to do a meme coin literally called Ponzi coin. Just take out the middleman. Fartcoin is in that direction, right? It's saying this is a total joke and you people will buy it anyway. But I thought Ponzi coin was even more direct. Turns out it's already done.
Really?
Yes. Wow. I cannot be the originator of Ponzi coin without landing in court.
Well, when that's taken, that's gone. But, related to that, I do have maybe it's a semi-serious question, but and I know what you've written about like bubbles. Bubbles are hard to identify in real time, and even in hindsight, it's not the easiest thing, right? But I do want to ask: is this time different, or are we in a bubble? You think? And again, this is total speculation. We get that.
Well, this time, um, I would say there are a lot of weird things, a lot of hyper speculative things going on, but some of the major indicators that I think have been helpful in the past. It is very hard. There are only really two times in my career I've screamed the word bubble. One was 99, 2000, and one was kind of 2019, 2020. Both times we saw the difference between cheap and expensive stocks measured either very simply using kind of Fama French type stuff, or measured using your favorite model today for value that includes growth and safety and whatnot, were the largest gaps ever in history. Like almost all people who identify bubbles, you're never exactly on time. I once joked who the gods would destroy, they make first to identify a bubble, because you kind of always lose for a year before you win. So be careful what you wish for. I still think those kind of indicators plus trend work better. They're not perfect either. Trend can get whipsawed, but it helps you avoid just that bubble going on and on and on, and maybe time it a little better. Where we are today, some of the things I've looked at in prior bubbles, the spread between cheap and expensive, that's wide versus history, but globally it's about the 80th percentile wide. At the end of 2020, it hit a new 100th percentile, even including the tech bubble, the way we measure it. I would jokingly call that the 125th percentile. And I won't fool you guys, but to some I'd enjoy occasionally pointing out 5 minutes later, there is no such thing as 125th percentile. It's the new 100th percentile. Though there was some content to it, right? It was that it was significantly more than the prior 100. That's what I was trying to convey. So by late 2020, we hit that. In 99, 2000, March of 2000, at the peak, we hit the prior high on that ever, and it was way higher, meaning people were paying a ton more for the darlings and a ton less for the out of favor stocks as a spread than they ever had before. So we did. I wrote a piece called Bubble Logic. We did think that was a bubble. In particular, at that time, the aggregate market, use your favorite measure, but the Shiller Cape was world record. We've never seen it before or after. It was like 45. Now it's in the 30s, and that's really freaking high. That's a technical term, but it's still not there. But today we're at about the 80th percentile, and we're high on the Shiller Cape, but we're not tech bubble high. So on some of the major indicators, I would be uncomfortable calling it a bubble. I have said I use the word bubble more than Gene Fama and less than almost everyone else. A bubble is a rare event where I can't come up with any assumptions that are within the realm of reason that could justify these prices. And at least for these big things, the value trade, again, either very simply or subtly defined, or the market as itself, I think it's an expensive market. The spread 80th percentile, I'm going to do some deep math, is considerably far away from the 50th percentile. It's not even an average market. But timing things, bubble things, I think get interesting when you're near the 100th percentile or you've passed the old one. They tend to be fairly extreme. 80th percentile, I downgrade my terminology from bubble to, hey, that's an expensive market. Maybe we should expect a little less. Similarly, the aggregate stock market is a high Shiller Cape, but nowhere near the peaks we've seen before. There are some other measures. People put them out. I think on a price to sales measure, the stock market is getting near its high ever. I could be convinced to get a little more negative on that, but I'm unwilling to use the word bubble, just broadly speaking. Having said that, the amount of things, and maybe this is just the old man in me, and I'm increasingly an old man, just getting annoyed at is the amount of things, the constant, 24/7 gamified trading, the meme stock people, not just crypto, but the crypto treasury companies. I mean, even if crypto is the greatest thing on earth, so I concede, it's wonderful. A closed-end fund selling at double premium on crypto still probably doesn't strike me as a good idea. So I think we have this market that is quite expensive, but I would not call full bubble. Again, I try to reserve that and try to use it very sparingly. But I do think there are a lot of signs that there are a lot more speculative people. Maybe that means it has more to go. Maybe that means it's a bad sign from now. I always caution people against market timing. But 80th percentile with an old man saying people seem kind of nuts out there, I don't think it's a great trading signal. So I would say I care about diversifiers more than normal. I would expect less out of simple market exposure, at least, because it is quite expensive. Not negative. I wouldn't expect the market crash. That's very hard to predict. But I would probably expect less over the next 5-10 years, starting from a more expensive level. But no, I stopped short of using the word bubble now.
So, one thing that's caught my attention, and Sonu and I talked about this on our podcast last week. I'd love your take. We don't need to get into the weeds of it, but the PPI number came in way more than expected. That's producer level inflation for the listeners out there. It was an 8 standard deviation event in terms of how much it beat what was expected. Now, Cliff, 8 standard deviation, as you know, and listeners, we said last week, it's supposed to happen once every 6.2 billion years. Happened last week. You've done this a long time. I'd love your take on how we seem to see these huge events that aren't supposed to happen in our lifetime. When it comes to markets, which I think kind of makes it fun, they happen way more than they're technically supposed to at a normal distribution. Take that away.
Let me antagonize someone for absolutely no reason, except it'll be edifying. The most annoying thing about Nassim Taleb.
Oh boy, here we go.
And it's a very long list, but he's also usually right. That doesn't mean he's not insufferable. That's a different issue. But his basic book, The Black Swan, there's a lot more in this. It's a very good book. Still massively pretentious, but a very good book. Says that these events, both daily, they could be daily announcements, they could be longer term things. The world is not very well approximated by a normal distribution. Some things are better approximated. 5-year average returns for the major asset classes don't look too bad. That doesn't mean one day we won't be surprised and have to change that tune. Shorter term things seem to be much more fat-tailed than longer term things. I went through what people often call the quant crisis or quant quake of 2007, August of 2007, which was a very bad week that all reversed it. It was a flash crash in the quant world, totally liquidity driven. That someone from Goldman just said without caveat, if you explain this well, you maybe can say it, but without caveat, I think it was the corporate treasurer of Goldman explaining their fund's really, really horrible week, said, well, we experienced a 25 standard deviation event, and left it at that. And forget the billions. 25 is like atoms in the universe kind of level. But that's not that we can all be cute with those things. But all we're saying is, again, particularly at the short term, but real life is more chaotic. The normal distribution doesn't apply. You do have to set up your life so you have very good odds, maybe never a certainty, but very good odds of surviving these short-term events. And announcements are like that. I mean, I'm not an expert on the Bureau of Labor Statistics and how they do that, but the world has changed a lot. They have more trouble gathering data. The tariffs clearly are making things probably move around just naturally more than they normally do. So we saw a very big number prior to that with the employment number that I think Trump ended up firing people over. we saw balancing things. We saw a lot in 1 month, but we saw revisions go the other way. I'm not even sure it was net bad news, but I'm not sure Trump got that message. So I do think we live in a time where not only is there some more danger out there than normal, but some of our traditional ways to measure things and I'm not a blame thrower on this. If the post-Zoom internet world makes it harder to do surveys, that's no one's fault. And maybe we can make a better way, but that's no one's immediate fault. That's just a fact of life. So I think if we go back through time, I'm not sure we'll find other 8s, but I am rather certain we'll find a lot of things bigger than 2 in the same data series. Again, the world is fat-tailed. Do I think that the CPI holding in and the PPI having that blowout number is at least worrisome that the tariffs have started to kick in? Where maybe in CPI companies are absorbing some of it, but in the PPI that's just the raw inputs from overseas. Yeah, I'm not a doom and gloomer. Whenever I change the topic to tariffs on you, but whenever people have tariffs, I'm like, I'm a free trader. I think very large tariffs will make the world worse off, but I think people overdo it when they're like, we're doomed. It's Smoot-Hawley. We're going into a Great Depression.
Yep.
About the most confident thing I can say is I think it'll probably make things worse because comparative advantage is real, and we're reducing the power of comparative advantage around the world. I think this may have been an early indication that we are gonna see some of that pain. But could all reverse next month. Economic data is a dangerous thing. I don't make my living forecasting the BLS, thank God.
Yeah. No, and to that point, a more general, I guess, frictions have increased. But I'm wondering, you wrote a paper last year on efficient markets or lack thereof. Less efficient markets.
Yeah.
Have things gotten a little more chaotic over time? And related question is, we started talking about crypto and things like that. Is there more? I can't say this in any good way. Like, is there more grift out there, right? And maybe it's because of social media and things like that, right? But is it easier to stoke memes and meme coins and do all this stuff now than it was 20 years ago?
I mean, do you know how easy it is to launch a meme coin? There are whole companies, you pay them like $9 and you can have your Ponzi coin out there. Not everyone catches on. It might not be worth $9, but
this is not a recommendation, by the way, anyone.
No. Legal doesn't let me do that, but you can take a wild guess what my recommendation would be about Ponzi coin. This is all anecdotal, right? I don't have a quantitative summary of grift. But I read everything on Bloomberg. I spend a lot of time on financial Twitter. It does seem the level of grift or grift adjacent. There are some things that I would not call full grift, but I think are just a bad idea for retail. I could get myself in trouble, but I don't think opening up privates to 401ks is a great idea. I don't call that a grift. Privates are honest professionals who are trying to do a good job. I do think there's more out there. The number of solicitations for things that are, even in the crypto world, that internet meme that has smart people over here and dumb people over here and regular people in the middle, and the smart and the dumb always agree. And it's the middle that usually have some common sense. And it's kind of like the smart and the dumb for very different reasons, love crypto. And in the middle, they're like, I'm not sure I should get involved with this whole thing. But I should also say the existence of grift doesn't mean everything is doomed. Again, I'm a Bitcoin cynic. I'm not going to run from that. But because there is a ton of grift, and there is a ton of grift in the crypto world, does not mean that Bitcoin is a grift. If you have disruptive, wonderful new technologies that are going to change the world, you're going to have a lot of grifters glom on. So it's scary and you have to navigate it. And it's certainly not a proof that Bitcoin's wonderful either. But I don't want to automatically throw the baby out with the bathwater. Grift is on the rise. Grift adjacent things that I think are just a bad idea are on the rise. But but that doesn't mean everything is doomed. It means you got to pay a little more attention. Make sure you're not clicking on that phishing email a little more vigorously.
I just literally got a phone call saying, give us a call back to make sure you approve this $999 purchase for an Apple iPhone 17.
Oh, well, my favorite, I don't know how I'm on this list, and this is a little bit of a humble brag for me, I admit, but I regularly get texts offering me starting jobs. And they quote the salary and whatnot. And I always, not always, but I often screenshot them and send them around to a bunch of people at AQR saying, are we having a much worse day than I think we are? Do these people know something I don't know, that I need this job? So yeah, there's a lot of that. The frequency of that is high, but how much it matters is hard to tell. Most of us have gotten pretty good, I hope. They prey on the most weak, the most uninformed, the elderly, and that's a real problem. But most of us have gotten pretty good at going, yeah, that's bull. That's not real.
Cliff, one thing I just thought of. So you obviously you talk about a job, right? If you weren't in the world of finance, what do you think you'd be doing?
Oh God. Well, I'll tell you, I had registered to take the LSATs before I decided to switch to the GMATs. That was a little bit of a tremendous amount of my family were lawyers. My dad was an assistant district attorney and then a defense attorney in Manhattan. I probably shouldn't tell this story on a public podcast, but my dad's first cousin. Feel free. My dad's first cousin was a guy named John Gotti's lawyer. Who was a bit of a major mafiosa in the 80s and 90s. We had some more, reputable lawyers in the family too, but it was a big lawyer family, and I always just assumed. And then at one point, my dad said, it was like junior year, I actually already signed up for the LSATs, and he finally said to me, like, why do you want to be a lawyer? And the lawyers I know, including myself, can't add. And you're kind of good at that math stuff. I'm pretty sure he exactly said math stuff. My mother was a math teacher, so I got it from somewhere. So I probably would have been a lawyer by default. Yeah. Short of that, something. I was really into computer games. You'll find this hard to believe, given I'm a quant geek, that I was really into computer games as a kid, and I was a computer science undergrad. So something in that field, only because it was fun and potentially lucrative. I certainly maybe could have gone down that route. I don't know if I would have done as well, but I might have had more fun with that job. So who knows? Path not taken.
Unless you ended up at Marvel or DC or something, right?
Yeah, I was never that creative. I can't draw. I'm not a creative writer. This is embarrassing, but my main connection to comic books is I like them. That doesn't mean I'm necessarily good at them. I like the Mona Lisa also.
I would argue you're a pretty good writer and creative too.
I've never written nonfiction, I should say. Maybe it would be a fun thing to try one day.
Or fiction, you mean, right.
Yeah. But I did get to meet Stan Lee once. This is a story I've never told in public. This is our third one, so you're getting the story.
Yeah, we're getting it all.
The story. What is that? There's I forget who has some title of like an album or something. The stories I only tell my friends. This actually was a little sad because he was quite old at the time, late 80s, maybe 90, and he was looking to restart a Marvel-like company. And some investment bankers knew I was a comic book collector. And I met with Stan Lee in my office. And when he walked in my office, there was a lot of comic memorabilia in my office. I did not plant that for Stan. That's just because I'm, an overgrown child. And I feel really bad because he had to walk in that office thinking, I got this. This is at least a medium-sized hedge fund guy who has my stuff all over his office. And it ended up, he wanted to kind of recreate Marvel from scratch when Marvel was still in existence, starting at the age of 90. So I told the bankers, if it's a tiny investment, I'll do it just for fun, just to get to know Stan and participate. But he wanted a lot of money. And at a lot of money, I'm not going with the 90-year-old guy. I'm sorry. So it was sad. I had to turn down one of my heroes.
Wow.
Oh, yeah, that's a great story. Speaking of, like, that's a Marvel site. Have you seen the new Superman?
I did. I liked it.
You liked it?
I didn't love it. It was, there's some the sci-fi parts with the black hole and whatnot seemed a little tacked on, but the whole tone, which I think they were explicitly going for, the prior DC ones were just black as night. Literally in their how they were shot, black uniforms, and the tone was just dark and sad. And this one had a tone much more like a lot of the comics, not all. Serious stuff, but a certain making fun of itself kind of attitude. Bright primary colors, which was a wonderful change. So I liked it. It wasn't my favorite one ever. They haven't made a really great one in a while, the Marvel or DC, if you ask me. Since Avengers Endgame, I think we got a bit of a problem. But I did enjoy it.
Which Superman out of all the Superman movies ever? Which one's your favorite?
Oh, Superman 2.
Okay.
When Zod comes to town. Yeah, that's not close. And if I have to do Superman 2, the Donner cut, which there's a cut that's kind of the producer who fought with everyone. It was really well done, and it was the most true to a comic book. The fights were comic book like. It felt like a live action, well done, special effects, good enough comic book. So you can watch that without Superman 1 too. So unequivocal.
I thought one of those guys just passed away, I think.
I think you're right. I forget this.
Yeah, I forget which one. One of the three of the one of the three.
One of the three, like two of the there was Zod and two henchmen. I think one of the henchmen just passed away.
Yes. But Ryan, how far off the rails have we gone here?
Oh, I think we're right on the rails. This is what we like to do on our podcast. We just got to know what did David say? The name of somebody there. He sent it to us. Terrence. Where did he put it, David?
Terrence Stamp.
Terrence Stamp. That's Terrence Stamp's the name of Zod.
Helpful. I would not have come up with that.
There we go. That's what David's helping us. Maybe let's go on task for a second, then we'll get off the rails again. One thing I know that we wanted to touch on, I know at AQR, you're working on this, Cliff, and other people are, just kind of the difference and changes at AQR just in the last 10 years, right? Because you think about, like innovation, if you stick with a process that worked for 10 years, that's great. But at the same time, the world is changing, as we just talked about. What, I'm sure you can talk for an hour on this, but like, what are some of the big things that have changed and you guys are doing differently in the last 10 years, or maybe even doing the same in the last 10 years that you think will keep working to help you grow?
Sure, Ryan. This is a hard one. I worry about this because anytime I publicly say something about this, somebody, particularly like someone in the press, will write an article. AQR doesn't care about theory anymore and only cares about data. Or and some of these things are directionally true. They are what I said. But what I tend to say, because you don't change a process that's worked. We're in our 27th year. And it's had good times, bad times, but many more good than bad, and it's actually worked. So you don't just change it willy-nilly. But so most of the changes are point in a spectrum kind of things, which is always less exciting to write an article on, right? AQR went from 50-50 data theory to 70-30 data theory. It's just not quite as punchy. But I'll tell you, I'll start with that one, because I think that's about right. I think we prided ourselves for many years on saying, and there's no perfect measure of this, this is a rough guidepost, that to make it into our model, meaning a characteristic of a stock or any other asset, that we like to go long the good ones and short the bad ones, had to pass twin tests. It had to make economic sense. That could be a rich, detailed economic theory, or it could just be common economic sense, that we think we understand why it's working. And then it needed strong statistical evidence that it does work. You can have the best theory in the world. If you have 50 years of backtest that say it doesn't work, we certainly bow to that backtest. 50 years is a long time. Capital asset pricing model is a famous example of this one. Beautiful model, very elegant.
Sure.
It's only not worked everywhere for really, really long periods of time. So, it doesn't pass the twin test. Over the years, partially due to new techniques like machine learning, but even after that, starting maybe even about 10 years ago, using more simple classical statistic techniques like just Bayesian updates, we started shifting to letting the data speak on which factors we would weight at which degree. The data would be back tests. It would be a larger weight on out of sample real life evidence, from after you did the back tests and you started trading it, how it did. And we found that importantly, you got to put some restrictions on that. If you wouldn't let it create every factor in the world and then shove it in and see what comes out. Because you get data mining, you get weird factors, you get strange things. But if you restrict it to things that you already think make sense in some sense, the weighting amongst them was just done better, first by Bayesian techniques and now increasingly by ML techniques. So I will say, we've moved somewhat from on the theory versus data spectrum. Again, I don't want people to say AQR doesn't give a darn about theory anymore, because I have had that reaction on occasion. But another one. We have pretty much, at least for 20 years, thought about dividing how we try to add value into what we might call true alpha versus an alternative risk premium or a style premium. And it's not always clear where to draw the line, I'll admit that. But let me give you some extreme examples. A alternative risk premium or a style premium, if you're doing Fama and French version of value, price to book, circa 1988. By the way, I'm not knocking them. I don't think it's the best you could do, but I still think over the very long term going forward, low will beat high. But if that's what you're doing, to say that's true alpha when the world all knows about it and has been trading it for, I think that's silly. But if you do believe it still has a payoff to it, maybe a lesser one than it used to, then it still can deliver value to your portfolio that's not very correlated to markets. So we would call that a style or alternative risk premium. Alpha is essentially something you think is unique, might be too arrogant a word, relatively unique. You have found something that is not in the popular domain, that has not been around. Nowadays, they may be ML strategies. They may be what are called alternative data strategies. They may be many others. But there's something that's not nearly as available. We always tried to do both. And we viewed a lot of portfolios as portfolios of the two. You get some exposure to the traditional things that quants like: value, momentum, quality, low risk. You know the litany. And you get things that we think we've pushed the envelope on. The mix here and the research effort here has become much more of an alpha one over the last 10 years. Some of that is just natural. The nature of risk premia is you can get better at implementing them, and so-called craftsmanship and how you implement them is pretty important. But you are pushing on a string after a certain point. If they are known things you've been trading for 20 years, maybe you don't think they've been arbitraged away. Like the value premium still 80th percentile wide. The notion that it's never going to work again because it's arbitraged away, it should be second percentile wide, not 80th, if that were the case. So we're still believers. But our efforts have really been more on the alpha side, and so far that's been, knock on wood, a successful one. Again, points on a spectrum. My fear there would be someone would walk away saying, AQR has abandoned alternative risk premium styles. No. In a lot of portfolios, we're still a portfolio of the two. But we've changed on that. Some conceptual things, which really aren't a change in what we do, but maybe how we package our products. I've changed how I use alpha and beta in constructing products. I'm going to leave out styles for now. I'm just going to go to alpha and beta. You guys probably know I've had a mini subset of my career whining about various things that sneak in market beta and kind of claim them as their own, like they're alpha. I started writing it along with two co-authors about hedge fund returns in 2001, showing that hedge funds made most of their money from their net long stock market beta. A lot of the rest was noise around. I have gotten the ire of private equity by saying, most of that is beta. It's a very expensive beta. They probably have some skill, but it's very expensive, and maybe it nets out to beta. And I almost got myself, I think even I almost got this wrong, because I started thinking about a long short diversifying product having beta in it as a bad thing, as a sin. And I forgot something crucial, which is really embarrassing that I would forget this. The sin is not having beta. The sin is charging alpha prices for beta. Having beta can actually be very useful. One of the problems with true alts, a true market neutral alt, is it's often not run at a very aggressive level. Call it a low vol. That's another issue.
Sure.
We think they should be run at higher vol. So if you move your money, say, out of equities into a very good, I'm gonna game the system and say I'm assuming it's a good market neutral, meaning you have a nice positive expected return, good risk adjusted returns, uncorrelated to markets. But if the expected return was decently under equities, maybe just because it's much lower octane,
Sure.
you can improve the Sharpe ratio, but not the top line.
Right.
You make less money. The Sharpe ratio went up because the vol, or the risk in a more general sense, went down more than the top line, but you still made less money, and which is not always what everyone wants to do. So if you attach beta, you can call this a portable alpha concept. You can
Capital efficiency.
Capital efficiency stacked, as my friend Corey Hofstein will call it.
Right.
If you add beta to a market neutral process, you want to be market neutral in our world. We do a lot of things where they don't let you short, but if you can short as much as you can long, we think you can have a higher Sharpe ratio because there's information on the short side. If you add beta to that, now you can allocate from equities into it. The beta in the new allocation, the equitized portable alpha, simply, you don't even think of that as part of the product. It just replaced the beta that you took away. So it's like you're adding the market neutral product on top for free. That's a little bit of leverage. No one should tell you adding another exposure on the same dollars is not at least a form of leverage. But now if you're truly diversifying, you are increasing the average return. You are possibly increasing, depending on how aggressive you are, possibly keeping the same, probably usually still slightly reducing the volatility of the whole portfolio. But you're improving the Sharpe, but you're also improving the top line. You take some things like, if you do this with managed futures had a bad decade after the GFC. It wasn't a disastrous decade. It didn't lose a ton of money. It wasn't a crash. It actually made money as we measure it. It just made a lot less money than the stock market did, right? And people got a little sick of it. 2022, it made a huge comeback, pretty much justifying a pretty long run of mediocrity. So it had a laugh at the end, but for a long time, people were very down on it. If you did an equitized version of it, all you did was add. The managed futures being positive added, and you were not taking it out of equities. That comparison gets taken away. It's not a free lunch, because if you lost, then you lost on top of equities. If you lose at the same time as equities, it could be worse. But it's a way for the client to decide, do I want to use this to lower my risk or raise my return, or some combination, where most traditional, truly hedged alternatives are really falling into the improved Sharpe ratio, maybe not improved return bucket, unless they're running a fairly aggressive level, some of which we do. And that's a change. We've only started recently offering that as products. That's one we should have done a long time ago.
You wrote about it like back in '94 or something, I think.
Yeah, I wrote about it in an asset allocation sense. levered 60/40. It's same concept though. You nailed it. Totally different venue. Most people wouldn't recognize the connection, but same idea. Lever the best portfolio, target risk. Eventually the guys at Wisdom Tree did a product based on my paper, which they gave me full credit for. And they did the out of sample on the paper saying it's worked in the 20 years since Cliff did the paper. So I don't know how to feel about that. I'm very excited it held up. And I'm a little like, why didn't I do that product 20 years ago? Why did I write the paper and 20 years, leave it for the two Jeremys? So that was nice. That was nice to me.
Now, full disclosure, we use capital efficiency as well, including Wisdom Tree and Corey Offstein's return stack products. And we believe in capital efficiency in our house view portfolios.
These are all great people. Choosing the one best at anything is a bad strategy. Choosing a portfolio of people who are good at things you believe in is a good strategy.
Well, I like that. Corey's coming to Excel, right, Sonu? Isn't he?
Yeah. He's actually going to be talking about capital efficiency at Excel.
So that'll be good.
No, I love the topic because I feel like you get away from Cliff. You've talked actually on our podcast about line item risk.
Yeah.
Right. Say you have a 60/40 portfolio and you want to, say going back to your point about, maybe it is an expensive market. Maybe it's not a bubble, but an expensive market. So what do? Diversify. Right. But now you want, let's say, a non-correlated diversify, like let's say managed futures or gold or whatever. Right. And now if you want to put that in your portfolio, you have to take something out. Yeah. Whereas with this concept, portable alpha, capital efficiency, or as Corey talks about it, you can stack it on top of what you already have.
Yeah. And it puts another burden, the diversifying nature, and people's worry that correlations all go to one gets bigger because you are just adding it. Mm-hmm. I think I'll brag for us. We have a 27-year history. Again, net very good, but some downs and ups, but they've been very uncorrelated to markets. So I am willing to take that bet, but I will issue the caveat that you got to do a little more research when you're net adding it, not just moving it, because you are in some sense levering at least a tad more.
Sure.
But I'm a believer in that. That's how I run my own money.
So we've got a couple more minutes here, Cliff. This has been awesome. Episode 150 of Carson's Facts versus Feelings with Cliff Asness over at AQR. A little more personal, have a little fun with this one. So I live in Ohio. My son just started high school today. Like today, the day we're doing this was his first day as a freshman. I've got a senior, a daughter, and then a seventh grader, another boy. So Cliff, you have some children, right? Right? I think
I do. I have 4 children.
Yeah. Okay, good. That's what I thought we talked about before. So I'm just going to ask for some parental advice here.
Oh, Jesus.
My son is smart. I mean, he is smart. Okay, he's a freshman. He's 14. He called my wife literally before we started doing this in a panic. I don't know where the bus is. He's like at a high school. He don't know where the bus is. Then he finally finds where the bus is. He's like, he calls his mom, my wife, and he's like, what bus am I supposed to get on again? Like, we went over this with him. He's 14. Do they get smarter or do they just stay stupid? I'm really worried. He's smart, but I worry, Cliff. I worry.
Hey, I have to, this is going to upset you, this answer. But
maybe not. Rip the Band-Aid off. Give me the truth.
Every kid is different, but I am still your son.
Okay. Where, you don't know what bus to get on.
Some people foolishly will think of me as smart, and I will call my wife and say, again, tell me where the towels are. And she'll be like, they're in the towel cabinet. And I'm like, oh. Yeah. So, I mean, some kids do mature much more than others. Some kids change a lot in 5 years. Some are the same kid. I wouldn't knock it too much. Some, smart, absent-minded and smart is a classic combination that often becomes productive in a world that where smart's pretty important.
Yeah, well, he's a good boy and everything. It just happened. So it was on my mind. I'll just put it that way. It's like, how do you not remember what bus to get on?
Have you considered corporal punishment?
Not yet. Only my wife will let me do that. Yeah.
Again, joking.
Yes, of course.
Absolutely.
Well, Sonu, we probably only have time for one more question, Sonu. So that was mine. Hopefully you can make a good one here for Cliff.
We could probably go 45 minutes.
We can go all day.
But maybe 5 minutes. So Cliff, I'll let you run with this. There's a whole kerfuffle about like buffered ETFs, defined outcome strategies. So these are basically outcome-based investing strategies, or if you want to call it target outcome, something like that. using options, what these products do is they tell you, oh, we limit the downside, but we'll also cap the upside, right? So the idea is the investor knows what the worst case is, but you guys have knocked that, right? And saying, you know what, you're probably just basically better off taking less equity market risk in the first place and putting the rest in cash.
Yeah. Yeah, we're going to end on me just dissing other products.
We saved this for the end, Cliff, for a reason, I think. Yeah.
No, it's fine. We've written 2 or 3 things on this now. The last one paraphrases Robert Heinlein. There is no such thing as a free lunch. There's a little hypocrisy there because there are things where we try to create a free lunch, uncorrelated expected returns. But I would say this, in simple financial engineering, there's almost never a free lunch. So you described it well. These products, and I should be clear, there might be some of these where they have a true alpha component. We think we have alpha. I can't rule out that in the universe of these, that there are some people who are quite skilled in giving you this pattern, but are very good at when to do it or whatnot. I can only talk about the aggregate findings we found for the whole field. So, if someone looks at hedge funds and says, Cliff, you wrote in 2001 that the average hedge fund doesn't really add value after fees and beta, yet you say your hedge fund adds value. I respond, yes. That's what I believe. The average being active management is an inherently arrogant act. It's entering a field that is largely a zero-sum game and saying I can win it. And I may be so arrogant as to believe I can. I'm not so arrogant to believe I'm the only one. So I would not say every one of these products is terrible. But I'd say this, they all do it a little different, but it's essentially what you described. It's buying options to give up some of the upside to protect some of the downside. Not a very hard thing to do with simple options. Some have more complex structures and whatnot. But imagine you do that. Let's do a simple one. You roll out of the money puts and you and you sell out of the money calls to finance it. So you're giving up some of the upside if there's a big run up, but you're cutting the downside from the puts. That works. You do cut. If you do that, not surprisingly, unless you bought your options from Bear Stearns in 2007. I'm joking. You probably even got paid on those with the settlement and whatnot. You do got to make sure you're trading with someone you will get paid if you're right. That is important. But so that part works. The question is that the right way to reduce risk? Because there's no magic going on here. And we think the empirics back us up strongly. But even forgetting empirics, in theory, this should not be a very good strategy. Options are expensive in multiple ways. One, we believe, and this is something I differ with Taleb on, we believe the variance risk premium is such that if you buy insurance, you lose money over time. If you sell insurance, if you're the scary side where you're going to take the tail risk,
right,
you get paid, but sometimes you get killed.
Sure.
And you get paid precisely because sometimes you get killed. So if we're right, and my colleague Antti Ilmanen has written a lot on this, and I do think we're right, of course, then you start out saying the option strategy is inherently buying some vol. So you're on the wrong side of the variance risk premium. Second, that's a back-tested gross number. Options can be quite expensive to trade, certainly relative to individual stocks. So number 2, you have a transactions cost hurdle that's going to be larger than normal. Number 3, I say this with great confidence, most of these funds charge more than an index fund, which is yet another hurdle. So all 3 of those say to us, there's no magic going on unless you have, and I wouldn't rule this out again, some alpha story separate from this. But if you're just doing the financial engineering, you are creating low octane or lower octane equities at a disadvantage because of these 3 things. How do we now empirically show that? Can't do it perfectly. We do it in sample versus what's occurred, but we look at what combination of stocks and cash best approximate each one of these funds.
Sure.
And I don't think there were any exceptions that were greater than one, like levered into the equity. I think they were all some degree of watering down equities.
Mm-hmm.
Like a buffered product might be best described, not perfectly described, by 70% S&P 500 index, 30% cash.
Mm-hmm.
Once you did that, comparing to that simple combination of stocks and cash, had a larger average return and did better in equity drawdowns. There were exceptions. We'd have 25 funds did worse, 3 did better, that kind of thing. We didn't get into naming specific funds. That could have been skill or luck. But the overwhelming results were, if you want to take less risk, simply take less risk. Doing complex financial engineering without a claim of alpha that's expensive at 3 different levels to take less risk is maybe more fun. Everyone feels like they're doing something smart. The old cliche, is it good at a cocktail party? It's much more interesting to talk about your buffered fund than to say, I raised some cash. But we do think they're in general, again, if somebody claims they have great alpha, I'll be as open-minded for them as I hope they'd be for me when I make that claim. But in general, we think it's financial engineering that's trying to solve a problem in a very expensive way that, to the extent it is a problem, is solvable in a very, very cheap way. And finally, I'll add one more thing. The concept of a free lunch going on here, if you want to just put it in more straightforward English, is to a large extent, I think equity investors get paid because, at least over short horizons, they're freaking scary.
Right.
So there is a massive free lunch aspect of, we figured out how you can have most of the upside and it won't be scary at all. And
Sure.
It doesn't come close to that, nor should it. It would be very weird if that was a massive arbitrage you could drive a truck through. So we are cynical about that. I know when people write things like liquid alts are terrible, they haven't added value, I get annoyed because I go, well, our liquid alts have added value. I won't argue for the whole universe. So I want to, for the 5th time, issue my caveat. Individual fund managers, make your case. But as a category, if you buy one of each, I think you should just buy stocks and cash.
Is there a placebo effect? I mean, you guys said that.
We literally talk about the placebo.
Right.
effect.
Like if somebody is in a defined outcome buffered strategy, and because of that, they think, we're in this, so we're going to sleep better at night. And because of that, they actually do sleep better at night.
Yeah. Well, this is very similar to when I get into my standard fights on private equity and I say the volatility is actually much higher than what they report. And people say, but it makes me a better investor. And I go, okay, but that's if you were fooled by it. Once you admit
Sure.
that it's a placebo effect, can't you skip the frickin' placebo? That part drives me a little mad. So I won't argue that if someone needs the placebo,
Right.
that maybe it'll make them stick with equities for the long term and it could work out better. But there's such an easy tweak once you're there to say it and admitted it's a placebo. I think the bigger one, the placebo effect, maybe the agency effect placebo, where if there's someone in between the end investor who doesn't have you guys' ability to analyze these things or ethics in analyzing these things, it's a more fun story to tell than just saying, well, we put 30% in cash. I think there's a big placebo effect. I think it can even work. I just think once you acknowledge it, you should move on and not use it anymore.
Yeah, because I guess nobody wants to pay for a placebo once they know that it is a placebo.
They're actually, not to disagree with you, Sonu, I believe, you can Google this, I'm not certain I'm right, but I believe I've read that it doesn't work as well, but in like real medical studies, they found even if you tell people something is a placebo, it still has some effect. Which I read in awe of that. I didn't even connect it to investing till this second. I didn't even think about it, but it is kind of funny. And again, I'm only about 80% sure I remember that right. But if I'm right, it's a fun result.
I'll look it up.
Just like you could tell someone we're calling it Ponzi coin and you're still going to buy it.
Yes.
Full circle,
Well,
back to the top, Ryan.
We could go a lot longer, but I know we probably need to wrap it up. This was amazing, Cliff. I think last time I said AQR and Carson are great partners. I got in trouble for that. We're not partners. Compliance, we're not partners. That's a bad word. I'll just say we're great friends. Obviously, we do a lot together. We are huge fans of you and fans of AQR, Cliff. Thank you so much for joining us the third time on episode 150. Cliff, I'll let you leave. 90 seconds. Tell us whatever you want to say to sign off with an amazing discussion. And you can sign us off. Take it away, Cliff.
Well, no, we are not legal partners, but we partner on many things that we think are
maybe that's
great.
what I got in trouble with. Yeah.
It's legal. I'm not immune to that. I do what they say. Their job is to keep you and I out of prison.
Yes.
So I have a special place in my heart for people who are going to do that. This field, I find it amazing how much I'm still learning. I find it amazing how much our research to-do list doesn't get shorter over time. You think, doing this at AQR 27 years and many years at Goldman and academia before that, you think you'd be done. You've exhausted all the whatever. But new opportunities come up, new problems come up where you haven't considered, is this strategy work here? So I think we're all collectively blessed to be in a field that I won't lie, that pays you well. It's something the world needs, and there's a reason for that. But is fun and really intellectually stimulating. And finally, I'll get on my high horse and says, rewards honesty and an intellectual integrity over the long term, if not always over the short term. So I'm happy and proud to be in this industry. Love to have you guys as occasional things we partner with. I'm trying to not the occasional people we partner with, but again, not legally partners, and share no co and joint liability. But I love what we do. I think I get the sense from you and Sonu that you love what you do, and I love talking. I'm saying love a lot, but I love talking to people who love what they do. So you can have me on anytime, and by any time I mean once a year.
There we go. Exactly. Once a year. So now listen, this is awesome. You ended it. That was amazing, Cliff. Thank you so much, everybody. Sonu and I will be back next week with episode 151. But I'm going to guess it's not as good as this one. I'm just going to say that right now. But all that, we're going to sign off. Thanks everybody for listening. See you next week.
Bye everyone.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM, LLC, or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM, LLC.